everyone, Tim Bohen here, back with Mike Huddie, answering all of your questions. Keep in mind, as you watch these videos, we've got hundreds of them, check them out on the side. Drop a comment in, drop a question. We really like to gear these videos towards what you want to learn. I mean, that's what's great about YouTube. It's a great resource. So drop those questions in and we'll answer them in every video. And also, if you're ready to take your trading to the next level, if you really want to get in depth, you really want to jumpstart your path to success, go in the links below, check out the StocksToTrade team. It's a program where Huddie and I do twice daily webinars, really get in depth on every topic. It's a year-long program. It's the best way to learn trading. So welcome back, Huddie.
Thanks, Bohen.
We've got another question today from Thomas Phillip, and he's asking, so we're focusing on short bias questions today since Huddie's here, and Thomas Phillip asks, so I've shorted a stock. It starts going against me. We've all been there. We may probably more times than we care to admit, but this trade starts going against him. He asks, do I set a stop order, a stop limit that will take me out at a specific area, a mechanical stop out in essence, or do I wait and manually, manage that order? And,
Sure.
He asked the big scary question is, do I then use a market order to get out?
So, and we're gonna have to break down this question into multiple parts, and it can be case by case.
Sure.
So what I'm gonna do is I'm gonna do my best to give a kind of blanket statement, but by breaking it down case by case.
Perfect.
And so first and foremost, when I'm getting into a short position, the first thing before I even get in the position is I know my risk. I know statistically.
What? You know where you're going to stop out before you enter a trade?
To the point.
Madness.
I know statistically.
I thought you were just supposed to hit the buy or sell button and then figure it out later.
As it's going up on you?
Yeah, exactly.
Yeah, no, that's not the right way. So before I get into a trade, I know exactly where I want to get out, where I know that this trade is going against me, where I know that my thesis is no longer valid. That point is a very statistical, unprobable point for the stock to get to.
Yep.
Before I even get into the stock, I know exactly where I want to get out. Okay, and so the next thing I look at is what's the share count of the stock?
Yep.
Is it a low float or does it have more shares outstanding? The lower the float that the stock is, the more violent the price movements can be. And so generally, when I'm shorting a low float or a micro float, I know I'm in a dangerous situation.
Yep.
And I know that it can jump 10, 20, 30 cents in minutes, in a very short amount of time, and I might not be able to cover it quick enough. So maybe in a situation where I'm dealing with a low float or with a stock that can move in a much more quick fashion in a shorter amount of time, I might use a stop loss in that situation because I know myself. And I know that I'm not going to be able to hit that button in time before it jumps 10, 15%, and then I'm a deer in headlights and I have no idea what to do.
Fair enough, yep.
So the lower the float, maybe I still know where that risk is. I still know where that point is that I want to get out at all costs. And I know that if it gets up there, it's going to breach right through and go crazy. Maybe I do want that stop loss in that situation.
Right.
The other situations where I use stop losses is, again, I know statistically what are the odds that a stock's going to get to a specific point, and I have the foresight of what it's going to do for the rest of the day. And so sometimes I don't want to watch a stock grind up on me and then only to collapse later in the day.
Right.
So sometimes I will put that stop loss in place if I have something better to do, like go to the gym and then check on the stock later in the day.
So the second, great stuff. The second part is he asks about using a market order to what I call panic out of a stock. What are your thoughts on? I mean, I'm guessing. I'm gonna read a little bit into this question, but I'm guessing he's probably short some low float, fast moving stock, and he's asking, do I keep moving my limit up to get out, or do I just take a market order and get out right away?
And I think in the beginning, it's so important to get out right away. It doesn't have to be a market order to get out right away. But again, the lower the float, the more you're going to want to just get out right away and have like 10, 15 cents of wiggle room. Sometimes it's, my risk is, let's just, for example, say $4, and I'll have a limit order ready at $4.20.
Perfect.
So yes, I'm going to experience maybe a 404 or 407
some
cover,
slippage.
But at least it's not going to go to $4.50, $5, I'm not going to know what to do.
Yep. And that's actually a key point. If you're shorting these low float stocks, you need to account for the fact that when they rip, they move fast and you might miss a fill. So keep in mind what he said there. Even though his stop out was 4, he was putting that stop out at 420 to make sure that it didn't go to 450 or 5 or 6 on him. So that's a great point. So I guess my biggest question, and I guess we can both give an answer, or both statement is, my opinion is, if you're shorting low float stocks, particularly these violent movers, I'm going to beg you never to use a market order. I think, in my opinion, you should be using limit sells, and if you got to keep moving that limit up manually to get out of this trade, that's what you have to do. I mean, it's annoying, it's frustrating to sit there and cancel and replace orders. We've all been there, cancel, replace, but I've just seen things get so bad with market orders, and you get terrible fills, and then, yes, you're gonna have some slippage with limits, but again, that's my opinion.
And again, in a market order, one fill can be at $4, the next fill can be at $4.30, and that's the downfall of the market order. You don't really know what price you're going to get executed at, and you can't account for that.
Yep.
The other thing I will say, and something that I take really close to heart because it's kept me in the game for 5 years, is no one trade is ever worth it.
Yep.
Right.
Well said.
It's one trade that takes back a month, a year of learning, of experience, of trades that you've built up your confidence through, and all of a sudden you took one loss and you've ruined years of learning. So there's never one trade that's worth it, and it's always, for me, the minute it violates my risk, which I know is a risk that isn't supposed to be violated a majority of the time, better than 50-50 at least. The second that's violated, I'm out at all costs. And it's not a market order, but it's a limit order that is much higher than what my risk is, so that I can account for that slippage and still get out without facing the full frontal blow of the squeeze.
Exactly. So 2 great points there. Number 1, and you'll hear me say it on almost all these videos, have a plan before you enter. Now, many of you might be watching and being like, what? Again, I joked about it earlier. You don't figure out your stop in advance. You would be amazed how many new traders we talk to, and they're like, I'm in this stock. Where should I stop out? And my first, I can be a little brutal at times, but my answer to that question is, you should know your stop before you enter. Don't ask me, don't ask him, don't ask Joe on the street. Your goal is to get out of that trade, and then next time, know your stop before you enter. Have that plan. And then the other thing is, again, I love that idea of your max stop loss. You've got that point where you're like, listen, I don't think there's any way this stock can get here, but if it does, I know things are going to get bad real fast, because that, as he said, very well said, one trade can take away 6 months, a year, 18 months. I mean, if you took a year to make $5,000 and you lose 7 in one day, you got to make back all of that. Yeah. It might take you 2 years to get back to where you were yesterday. So no one trade is worth it. Very well said. And again, if you love these videos, which hopefully you do, drop us a comment below with another question. We love answering all of your questions. And if you really want to get into the nitty-gritty of trading with Huddie and I in these webinars where we have direct chat access to us every single day, check out the Steady Trade team in the link below. And please ring that bell, hit the subscribe button to be notified as soon as the next video drops.